Welcome one, welcome all to DeFi Crypto and Airdrops Money Talks Edition, our Thursday show. And with us today and every Thursday is Taylor, an estate lawyer in McKinney, Texas, and his business partner, not life partner, Jeff, who is a licensed financial advisor. In this show, we like to focus on all aspects of wealth generation and wealth preservation. I talk mostly about DeFi or decentralized finance. Taylor talks about protecting your wealth, your assets, and Jeff talks about investing, TradFi, stocks, bonds, treasuries, and other vehicles like that. So with that, how's it going, Taylor? How's it going, Jeff?
Fantastic. And sometimes I wish Jeff was my life partner.
I can't blame you.
I know.
All right. First I can make.
Yeah.
So, what are you guys seeing? Let's just jump right into it. What are you guys seeing in the markets today? As far as news, just macro news, traditional market, stock market, tariffs, whatever.
Well, currently, we don't need to panic. There's nothing on the horizon showing the fact that the Fed didn't, cut for whatever. What was it? They were going to cut for because of the everybody was asking for cuts, and I'm like, why are you asking for cuts? There's nothing in the economy right now showing that they need to cut rates. And but everybody freaked out yesterday and sold off like crazy, and then it bounced right back within 30 minutes. So
and I think that's an excellent point. And it's like literally our president, who I'm again not a super fan of, mainly because of how he litigates our entire country's policy on Twitter and social. But he's like, I think I figured out his issue with the rate. Besides the fact, obviously, he wants people to be able to afford housing better because that unlocks the housing market, and that's a really significant pain point for us regular Americans.
Yeah.
And Taylor, since he owns a title company, but I think he views this from, unbeknownst to him, I think he views credit in the way we all view like personal credit. Like the person that has that 850 credit score pays the lowest borrowing cost, right? And his argument is, hey, we're the biggest economy in the world, we're growing, yada, 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 right? And therefore we should pay the least amount. And to some degree, that's true in the sense that we have been historically the safe haven capital depot of the world. But he himself has undercut that. Even if you love the way he's unpredictable, you know who doesn't like unpredictability?
Markets.
Foreign countries with sovereign wealth funds, right? So they don't trust that he's going to do or not do. It's like, we don't want to put money in the dollar and then he raises tariffs on us or this. I mean, there's all kinds of kind of geopolitical economic things that are affecting the marginal buyer, which is very large institutions and sovereign wealth funds that aren't putting money into treasuries maybe as much as they should, which would push rates down some, right? But what's frustrating to me is he says things like, the economy's great, rates should be much lower. The Federal Reserve uses rates as a steroid shot when the economy's not good. So you lower rates, look what happened after 2008. Look at what happened after 2020. You lower rates when the economy isn't working, when people aren't employed, when inflation, when unemployment's going up, when there's significant stagnation in the economy, to lubricate the wheels of finance, to make it less expensive to open businesses and expand businesses and hire people and all of that stuff, right? You don't lower rates when things are going good. You raise rates when things are, now we don't need to raise rates, but let's say if we had blown it out of the water at a different level, because by the way, they're acting like this 3% print is amazing and oh my goodness, we've never seen, dude, we did 3% for the last 6 quarters of Biden's administration, and people are like, well, but you can't trust that. Well, it's the same government agency. So if you can't trust it then, you can't trust it now. And if you can trust it now, you can trust it then. So that's a decision you got to make. But here's my point. Rates are not low because we are America. Rates are lower when we are in trouble, and they're higher when things are good to avoid inflation. So if they cut rates significantly, we will see inflation. And one of the places we'll see inflation is in housing, which will just make it more expensive for everybody to buy.
So I want to bring up this point because we talk about this all the time, because there's a general consensus that the stock market, everything is significantly overvalued at this time, but continues to like we're basically in we're almost at the 2-decade mark of the market just going straight up. And the question is why? Why does it just keep going up? And one of the things that me and Jeff have been talking about a lot is this idea that, well, inflation is happening more significantly in the market than it's happening in people's general lives, because when they lower rates, money doesn't proportionately go out to everybody. The majority goes to the wealthy. And then what the wealthy are doing, they have so much money that they're just taking it and putting it back into the market, driving up stocks higher and higher and higher. And we've been talking about this issue of, well, everybody's kind of on this bandwagon that some people say it's 80% overvalued and there should be an 80% pullback. Well, Jeff and I are kind of the opinion of going, yes, there's going to be a pullback, but it might not really come down a lot because of the reality that most of the money is held by the wealthy. And they're just going to, unless there's some event that forces wealthy individuals to pull their money out, regular folk like us are just going to, we might pull all of our money out and it goes down another 10, 20%. But then the wealthy are just going to keep putting their money in.
I like that. Who put that up?
I did.
That's genius. That's great.
Yeah. And for those that can't read, if you're on your phone, it says, in investing, always remember that Rome was not built in a day. In trading, always remember that Hiroshima and Nagasaki were destroyed in a day.
Yeah. But the reality is like a lot of people are fearful right now, and a lot of people are just sitting on the sideline. Mm-hmm. What might be happening, no one really knows this. So I went through some different things of like, okay, what if like stock market inflation continues at this 10 to 20% rate, and so we go another decade of everything going up 10 to 20% in the market, and all of us are sitting on the sidelines fearful, going, I don't want to put my money in, because if I put my money in and we have an 80% drawdown, then I'm screwed. So Jeff has had to come up with some creative financial planning strategies of how do we help, especially elderly people, not get this, this gain that's happening that in the market, but also at the same time not risking everything at the end of their life, and then all of a sudden market pulls back 50% and they're screwed.
So, yeah, fixed income people are, that would destroy them.
And it's something that I think, so there is so I did some research. I mean, I went way in a rabbit hole. Me and Chat GPT went down the rabbit hole like Tuesday night. I didn't go to bed till like 2 or 3 in the morning. And I asked it, and actually it's not ready for prime time yet, but I'm kind of building a white paper. I mean, not something I'm going to publish, but give clients. And I asked it, how many bear markets were there since 1900? And it's like 21. Then I had it re-rank the bear markets in order of extreme valuation in the market, in the stock market, right? Using different metrics like we've looked at before on the show. And believe it or not, actually the highest value ever was 2022, right before we had the 25% correction. Or maybe it was like 19% in the S&P, 25% in NASDAQ. And then below that was 2000. And then I just asked it, I'm like, well, if you use those same metrics and you presume, when we look back in history, that a bear market started in June, which obviously a bear market didn't start in June. We're higher than we were in June. But that's the last completed month it could give me data for. June's valuation is the third highest of all time in recorded stock market history. And wow, we're higher than that. Right now, again, AI may be the next thing. I mean, it is the next thing, but it may be.
But Jeff,
it might
what
go
about?
on for who knows how long.
But Jeff, let's deep into what if really what's driving the market is not AI, it's not these valuations of companies. It's purely that all the wealth right now is going to the wealthy, who are then just putting it into the stock market, and it's inflating.
Yes. No. So we have a huge problem with they call it a K economy, where like the top 10% are like this, the rest of us are kind of like this. And even if you're not getting like less money, you're getting less.
Wait.
Right.
Jeff, qualify that. The rest of you, I'm up there in the.
Well, there you go.
You
So,
got it.
so what I think though is much so. First of all, just understand from an historical perspective. When you look back, and again, history changes, right? But when you look back, if you look at the CAPE ratio stands for cyclically adjusted price to earnings ratio. What that means is Robert Shiller came up with it. He's a Nobel Prize winning economist at Yale. He came up with this idea that instead of looking at a company any given quarter, because a quarter can be really an outlier, right? Maybe they had something really cool happen, or maybe they didn't. They were able to take a bunch of depreciation or losses, or who knows? It kind of is very noisy. But if you average out the 10 quarters, rolling 10 quarters of the market, you can kind of see what the average valuation is trending on. So a better way to think of it, a company, like if you really want to know what Microsoft is worth, obviously it just went through the roof yesterday, but let's just say it, and I'm making these numbers completely up because I don't think it's ever hit this, but let's just say it was, or Tesla, if it's 400 in January and it's 200 in May and it's 800 in August and it's 300 in December, well, probably, because not that much changes in a year, probably fair values, averaging those out, that's probably closer to what the real value of the company is.
So Jeff, right? real quick, what was that called again?
CAPE, C-A-P-E.
It's
a measurement, cyclically adjusted price to earnings ratio. So what they do.
Hold on, a CAPE what?
CAPE. Just look up CAPE. It's an indicator. It's a valuation of the market. So just if you Google, Shiller, SHILER, CAPE.
Hey, Miles. Hey, hold on real quick, Jeff. Hey, Miles, real quick, what is in investing? What is a CAPE? What is it called again, Jeff?
CAPE
ratio.
Yeah. Tell me in the audience and try to break it down as simply as possible what a CAPE ratio is.
Gotcha. Okay, so the CAPE ratio, that's cyclically adjusted price to earnings ratio, is basically a way to see if the stock market is overpriced or underpriced. It uses average inflation adjusted earnings over the last 10 years instead of just 1 year's earnings, which can be kind of wonky. Think of it like this. It smooths out the ups and downs to give you a longer term view of whether prices are high relative to what companies are actually earning. A high CAPE ratio usually suggests the market is expensive, and a lower one suggests it might be a good time to buy. It's not perfect, but it's a useful tool for getting a sense of things.
Cool. All right. Just simplified it. I'm not, a lot of what you were saying was over my head.
Wow. So here's the point I'm trying to make. And this is super, because first of all, CAPE ratio has been really elevated for like 8 years. So it's not a timing tool. But if you go back through the last 150 years of markets and unfortunately for us, things can stay really, really elevated or really, really low for a really long time. So it doesn't really work for us humans. But just from a mathematical framework, if all you did was sell when the CAPE's above 25 and buy when it's below 15, you'd crush. Like, to give you an idea, the CAPE ratio right now is 34, which means it takes on average $34 of purchase price to get $1 of earning from your average stock in the stock market. Okay. In 1980 or 81, it was 7. So you spent $7 to buy a stock that had $1 of earnings. And the next 2 decades, the market went up 18% a year. When you look historically, the 10-year returns after you hit these kinds of extremes, not so good. So let's look at 2000. The 10-year average annualized return, if you put your money in January 1st of 2000 and you took it out January 1st of 2010, you lost, and I'm assuming you had a stomach of steel, right? You just rode it.
So Jeff,
You
let's
lost 1% a year in a
for the
decade.
sake of time, let's cut to the chase here. So what I'm getting from what you're saying is that the markets are overheated, that maybe there's a bit of a bubble, from what you've
No,
said
I'm
just
saying historically we're in an extreme bubble, but nobody knows when it's going to pop.
that's what I'm saying is, so what are you suggesting to clients right now that they do if they're in traditional markets?
I'm suggesting, so my clients, so I built a tactical model for this, but you have to have a solution for if we have another 2000, 2008,
Mm-hmm.
87, 73. It happens once a decade, basically. You have to have a solution for that, which means not buy and hold is probably not going to work. I mean, it works till it does. It won't work in the when the switch happens, right?
How are you telling clients to mitigate risk?
I'm having clients mitigate risk by being in alternative investments, right? And I'm finally recommending, Bitcoin as part of that,
Yeah.
right? Well,
Yeah.
all I needed was Congress to say yes. And
Yeah.
Congress has now said
No,
yes.
no. I'm not laughing at you. I'm laughing because that's how fast stuff's moving.
Right.
Is we have legislation coming down, and you, as a fiduciary, you have a legal obligation to not advise people to invest in things that don't have a legal framework. So yeah, no, I totally get it.
And that was the hand that I mean, separate from it being a very wild westy, confusing kind of place, just knowing that the government that directs the IRS is on our side on that is huge, at least for now, right? Number two, alternative investments like oil and gas, private equity, private credit, commercial real estate. There's all kinds of other things. Although commercial real estate is probably not a great place right
It's
now.
funny that you mentioned those.
And then lastly, I use principally protected strategies or hedge strategies, so that if the market goes down, you don't lose any or you lose some. Now, there's always a cost, right? Nothing's perfect. So, for example, I have some conservative investors last year that used a principally protected strategy that, because the market killed it, they made about 14 to 18%. Okay, whereas the market went up like 25, whatever it went up. But I was using money that those clients otherwise had in CDs or money market accounts or cash. So it's money that they don't feel they have the ability to risk unless it's in something that's got that kind of structure. So I think that's really important because, as Taylor's pointed out on the show several times, the average Joe or even the above average Joe, until you're really, really, really killing it, it matters that things are 25% more expensive than they were 4 years ago. Particularly in the things we really care about, like, I don't know, buying steak, So I'm just telling people the challenge is this. You cannot afford to not be invested because you have to combat inflation, and who knows what the future holds. But you also, most people, especially pre-retirees and retirees, can't afford a 50% haircut. So the just set it and forget it mentality, the worst part about where we are is people get complacent because they're just like stonks go up, right? That becomes the meme, and it works till it doesn't. Now, to Taylor's point, because we've talked about this, and I don't have any kind of metrics to prove this out. I'm doing some research on it with some people that are much, much smarter than me, or I'm rather read their right research. I do think there's a world where maybe the way the market doesn't perform is we just kind of go sideways. Or we have a market that continues to go well, and it just gets further and further and further divorced from a greater and greater and greater amount of people's lives.
Yeah, like I want to explain that a little bit because I think it's already happening. The Great Divide, it's already we're well into it, basically since COVID, and that is there is this group of people who are super wealthy that are just going to keep getting wealthier because they're going to do everything to save them. And everybody else is already left behind in a very literal sense because they cannot keep up with the inflation costs.
Oh, look at credit card debt.
Yes. The reality of the situation is our generation, your only way that you're really that I can see is like, yeah, you're going to have to play this game. But I think the best kind of strategy is we're going to continue to have these things are going to shoot up and then we're going to have like a 20% drawdown, and then they're going to do whatever they can to save it because they're going to freak out that the whole market's going to collapse because they all know that they're screwed, and then they're going to do monetary policy to push it, and then it's going to shoot back up again. And I think if you can learn how to play that game of be patient, wait for the drawdowns, and then understand, well, either two things are going to happen. It continues to go down and the whole US economy is effed and your dollar doesn't mean anything.
Well, the world economy, if the stock market goes down enough.
Yeah, the world economy goes. So why do you care then so much? So, and then they're going to keep doing the policy of basically bringing down interest rates until they bring it down to zero to save it. And then once interest rates are at zero, and they have to keep it there for a long period of time to keep things going, it's pretty much going to go flat. It's because they won't have any other tools to keep things going other than, pumping the rich, keep pumping the market to go up. But I think what you're going to realize is the benefit is going to be in things like Bitcoin, things like gold. They're going to be
commodities.
You got to just hedge the inflation that's happening. And Bitcoin, I think, is going to be, unless it's always contingent upon somebody getting quantum computed going enough that they can now start hacking, our wallets. And there's nothing we can do about that. If that happens, the crypto market's gone. But
if that happens, every market's gone. I mean, bank accounts can get hacked. Freaking secure databases. I mean, really, the only way that you could avoid not getting hacked would be if you're not connected to the internet. If it's just
talking
totally
about that, I want to bring up something I didn't know.
What's that?
They'd have to come up with some kind of quantum encryption to fight quantum breaking traditional encryption.
So I didn't know this, but back in 2003 or 2023, sorry, Chase, my bank, sent out a thing on October 16th stating that they were going to flag any transactions buying crypto.
Yep.
And not allow it to go through. I was wondering why, because I will go on all the time, try to buy crypto through my wallet, and I have to go through Coinbase to do it. And I'm like, why won't these transactions go through? I didn't know that it's Chase Bank that was stopping me from buying. And then, now they come out with this whole thing like we're partnering with Coinbase. Basically, like these motherfuckers were stopping me from buying directly. You have to go through Coinbase to buy if you have Chase Bank.
Yeah.
And so, and the thing that people like, someone like Jeff, so like Coinbase sells, like you can't buy Bitcoin on Coinbase for its actual value. You have to, they sell to you like cheaper. I forgot how much the difference is usually. Yeah.
That makes no sense.
What is the rate there? Because I don't buy anything on Coinbase anymore. I
haven't bought anything on Coinbase forever. I actually haven't bought any crypto forever because my DeFi, all this stuff, I'm making a bunch of yield. I'm making a couple of $1,000s a month, and it's going directly into stacking my bags. So I stopped like 8 months ago. I stopped buying crypto with my own money
and just keep stacking it. But that's funny because, in my opinion, because Jamie Dimon came out and said that he's deeply opposed because he says Bitcoin is for criminals. And I'm like,
oh yeah, no, he threatened to fire people that worked for him if they bought Bitcoin.
But secretly,
they were stacking.
They've created this system where you have to buy through the company they choose. And that's, deeply concerning to me. Like,
yeah,
you have the authority to say where I can buy something from. That's crazy to me. But anyway,
and it's important to understand that a lot of these institutions, they are actually buying over the counter. So they're not, sometimes they go to the actual exchanges to buy if there isn't available Bitcoin or whatever. But for the most part, they're buying over the counter. And that's why it's not affecting the markets as much as far as price appreciation or depreciation, because they're buying from individuals, or other institutions. So, it doesn't affect the price as much. That's what they're doing right now. They're driving the prices down so that they can stack at cheaper prices. And then once they feel like that they have enough, they're just going to let it go.
Well, they'll get the government to buy, and then the
Mhm.
government will make them freak, just wealthy beyond unbelief.
Yeah.
It really is going to be the biggest play that happens, I think, is you're going to see there's going to be a big drawdown in Bitcoin at some point between now before the government
Adopts it.
adopts it.
Yeah.
And everybody's going to freak out and everybody's going to bail. And then they're going to be buying it all up. And then they're going to they're going to get, Congress to pass whatever law and everything that they're going to get the government to buy a bunch of Bitcoin and drive it up.
Well, and the thing is with all of that is that, and with any investing really is follow the money. Look what the rich are doing, not what the rich are saying. If you follow what they're saying, you're going to get wrecked. And that's the beauty of crypto. If you know what websites to go to, all the information is on chain. It's 100% transparent. Once you understand who owns what wallets, and there's a Whale Watcher is one of them, but there's a bunch of accounts on X that you can follow, and they post all the time. So and so, BlackRock just bought this much Bitcoin. Michael Saylor just bought this much. And they just constantly posting about it. You don't see any of them selling for the most part. You see them all buying as much as they can, as fast as they can.
You'll be proud of me when I mentioned. So I think Jay earlier said something about it paying me to recommend Bitcoin. Only thing that pains me about Bitcoin is when I was sitting next to the homeless looking dude in 2010 or 11 telling me about his Bitcoin, and it was like $60. And I'm like, okay, dude.
Yeah.
And that kid, I mean, he probably sold it all for pizza and weed, but if he didn't, I meant like the guy that's worth a couple $100 million now. So who knows?
Well, if he didn't, Jeff would like to be your financial advisor. He can advise you on how to.
If you're out there, remember me? I talked to the whole flight. Here's what I was going to say though. I bookmarked it somewhere, but it's like way down on my bookmark. I'll find it for you, Michael. But somebody that's a crypto account, I don't know if it's somebody legitimate or not, but somebody's got a decent amount of followers, said something like, Bitcoin will the cycles aren't done. It will once again fall 80%, just not yet. And then people will panic and act like it's over again, it made me think. Now it will be interesting to see if we go a couple of years or whatever the normal phases are, right? Wherever we would if it's possible that cycle could be significantly dampened because of all the legislation and because 100%. Of all the right? But
real quick, Jeff, I'm glad you brought that up, and I want to put an exclamation point on it, because we are at a crux or a tipping point right now, because the past cycles were different. I know that everybody says this time's different, but the last cycles was almost nothing but retail, because people like Jeff, institutions legally could not get involved in this market. So it was 100% retail, and retail is emotional. They're not smart money. And that's why there's those drastic swings in price, because once people see that it's selling, and you have influencers on social media saying we're going into the bear market, everybody panics and sells, and it causes a cascade effect. That's why you saw those huge fluctuations. Now you have institutions and governments buying Bitcoin, buying crypto. We're moving from speculation to a utility-driven market. Now, what you need to be careful of is making sure you're investing in fundamentally strong projects that are part of this infrastructure that's being built. Because if you're not, you are going to be buying the pets.com and the Yahoos, and not the Googles and the Microsofts.
Yeah, so that's a great point, Michael, because before there's all these people online that are like, oh, this altcoin is going to take off. Well, no, because before, the people who had the money, or the people that were making the money, were these retail guys, or just these Smo Joe that was making millions of dollars, and then he was jumping over to Dogecoin and pumping that up and making a ton of money.
Mhm.
The institutions aren't going to buy Dogecoin. They aren't going to
No,
buy those projects. They're going to stick, like right now, institutions are in
they're
Bitcoin, Ethereum.
Bitcoin, Ondo, Chainlink, all these ones that are part of this infrastructure that they're building out for tokenized assets like stocks, bonds, commodities, treasuries. JP Morgan Chase, they're building on Ethereum. They're, talking about coming out with their own stable coin. That's
Well,
what they're buying.
so with that as a, I'm sorry, I lost my train of thought. But what I was trying to get to, and what I want to make sure I get out is, to me, nobody. So here's what I need to share my screen really quickly here. Let me go
Yeah,
back
go
to
ahead.
it. Let me hit share screen, and I want to do this. So this is inflation since the 70s, right? The 60s. First thing you'll notice is what happened right here. We got off the gold standard fully, right? And since then, the purple. First of all, can you see what I'm looking at? I don't even know. I'm on
Yeah.
a different screen. Okay, cool. The purple is core inflation, right? The other one is core consumer price index, which I think one of the differences, I believe, the consumer price index includes things like food and fuel, which are very, as you can see right here, are very volatile. The core breaks out, doesn't do food and fuel because it just moves too much, because they're because obviously food, right? We've heard of pork bellies and wheat futures, and food's a commodity, oil and gas is a commodity. It's just very sensitive to all kinds of things. And so it can mislead, it can give you some misleading numbers, even though obviously we all care about eating, we all care about going somewhere. So it's a bit disingenuous not to include it, but it does make it a little bit more predictable. What I'm simply getting at is that chart only goes one direction. And then that big inflection point here is when Biden, I hate saying it that like that's just his fault, but when our Congress, led by the Biden administration, decided to print way too much money during COVID, right? And it put us on a different path that we're trying to curve that down now. But all I really care about is that graph goes up and to the right. So my arguments to people for Bitcoin, which I'm certainly not a Bitcoin maxi yet by any means, but I'm going to say, if you are going to allocate to it, in your mind, I don't give a damn what happens in the next decade.
Yeah.
This is a decade-long thing. So if the cycles did stay, and if Bitcoin went back to 30,000 or 25,000, like, if you like it now, you got to like it then. Like, this is a thesis. If you're going to do this right, as an investment advisor, my
It's a
opinion, I'm a
thesis.
certified financial planner, what I'm recommending my clients is, you were not buying this to make money or not make money. You were buying this on a thesis. And the thesis is, this is going to be my hedge against the dollar and inflation in general.
And is this investment going to outpace inflation?
Correct. And in that case, what that graph tells us is, the longer I live, the bigger inflation's a problem from wherever point I started. Mm-hmm. So it should be considered a super long thing. Now, that being said, I do think institutions will dampen it. The more retail, the more it becomes more conservative retail. When the boomers get in and the retire, it will dampen it some. But to some degree, degens are still degens in anything.
The more liquidity that there is, the less that individual institutions or anything like that will be able to manipulate the market. Because right now you can watch it in real time. There's websites you can go to that have the heat maps where the longs and the shorts are stacked up, and you can watch. I mean, it goes up, it liquidates. It goes down, it liquidates. It goes up, it liquidates. It goes down. It's this windshield wiper that just does nothing but liquidates all the retail people that are out there.
The analogy I used is, for the client I was talking to, is I was like, look, if you go to a poker room in Dallas, right, an underground poker room, or you go to an underground casino, the money in there is moving. It's massive swings of wins and losses, and everybody is a degenerate gambler, right? Everybody's they're just firing capital. But if you go to Vegas, right? There's high roller rooms. There's somebody there that's going to put their mortgage into a slot machine. But there's also like, my wife that will go out and be like, oh, I gambled my $50 and I doubled it and I'm done for the trip,
Yeah.
right? Or I lost it and I hate it and I'm never coming back, right? So what I'm getting at is I do think there's going to be long-term dampening of these vicious cycles, but the people that have driven those cycles, the people that have gotten 1,000% returns in a day, they still want those. Their psychology is not going to change. So that's still
they're looking for that endorphin bump. Absolutely.
Right. And they're still going to be part of this ecosystem. It's just not going to be the only driver of it. So I'm telling people, if you buy Bitcoin, you have to be willing to wake up one day and it's just plummeted. And if it has, or plummets over months, if you can't take that and hold on to it and dollar cost average into that, then you should not own it. Not because it's not a great idea, not because whomever is in the comments that are Bitcoin maxis aren't correct, but because if the people can't take the ride, it's not for them yet.
So this is the graphic that I have pinned to the top of my X account. And it's basically my DeFi rules, when choosing a liquidity pool. And number one is what you're just saying, is believe in the assets. Because and it's for that reason, because it's going to take the emotion out of that position. If you're buying Bitcoin and you believe in it long term, if you have a long-term thesis, then it's going to be easier on pullbacks to hold that. Now, if you're in some meme coin, some obscure meme coin, and you're in a pool or you're just buying it and there's a pullback, in the back of your head, you're always wondering, okay, is this thing going to zero like 99% of meme coins do? And potentially, yes, it's going to, but you're more likely to exit that position, lock in those losses, and then even if it pumps later on, you missed out. Or it might go to zero, but you lost money. So it's very important. And that's why I personally, the way that I remove emotion from my investments is I do a ton of research on the projects I'm invested in. I look at the fundamentals. I look at the team. I look at the investors. I look at the tokenomics. I look at the use case and the pain points that they're meaning to address, all of those different things, so that I can remove the emotion, whenever the market swings. So like when prices tank, like they have been, I still believe in the projects because nothing fundamentally has changed. The price has gone down, absolutely. But it's not like this, the CEO quit or they have a lawsuit against them, or some new legislation made it to where it's going to put them out of business. Those are the types of things that you need to reassess your investments, not because the price dipped or somebody on social media, put out something that was negative about your project. So
right. That makes sense.
That's basically,
before you get off your research. You see in the comments, Deadwood's talking about fiat leak. Are you familiar with that?
Yeah. So basically what fiat leak is, here, let me find that real quick.
It's the last comment, I think, or close to the last comment.
I'm actually not seeing that comment. Well, fiat leak, here, I'll go to it real quick. It basically what it is it shows the movement of certain assets. So like this one right here is XRP. And so once it finishes coming up, you'll see all these transactions just, blazing through, and, how much, they're sending and stuff. But it shows that, how the, how the token is moving. So right now, it's still ramping up. What's that?
First of all, it looks like it's coming from Antarctica. What the hell?
It's coming. Look at the flags down here. So you got some that's
okay.
from Antarctica. The aliens.
I was
The aliens
like,
are
damn, those
XRP.
aliens are investing some cash.
Yes, the Antarcticans are investing in XRP. So you got USD, flowing to the US. You got the euro. There's some flowing there. Looks like South Korea, you have some, and that's about it right now. So, but this shows, and then of course you can go to other assets. So like if we want to look at, Aave or ADA or Algo, AVAX, AVAX is another good one. Let's see what AVAX is doing. But this is the beauty of crypto, is all of this data is on chain. I mean, these are tools that traditional investing, they used to spend millions of dollars to have access to. This is tools that all of us sitting, me here sitting in a cabin in the middle of the woods, I can see how, liquidity is moving on these blockchains. So it gives me an idea of, what the actual volume of use is, as opposed to, what I read, on, in traditional media or on a social media post. So if everybody's like, oh, Avalanche is going crazy right now, I can look on here. I wouldn't say it's going crazy, but there is movement. But yeah, I mean, this is the beauty of crypto, and why I like it so much, because I love looking at data, because that's what, what informs my investing.
Speaking about informing investing, I just saw a tweet that says the Fed holds steady, but there's 2 dissents for the first time since 1993.
Wow.
So, and with that, something else I'll tell you, and I read this fast, but so GDP, right, which stands for gross domestic product. So imports are not part of that in any way. But you have to account, because it counts all final sales that are made in this country in GDP, even if you're selling something that you imported. So I don't want to act like I totally understand the relationship, but I do trust the person I'm reading this from. And it says imports added 5.18 percentage points to GDP calculation, not the final number, but the calculation. Imports never add or subtract from GDP because they're not domestic. However, the BEA, which is the Bureau of Economic Analysts, that's who prints the GDP, counts all sales as domestic sales, so it must then subtract imports from its calculation. Trade data due to tariff threats has seriously distorted GDP in ways never seen before. If you want to get a better look at how is our economy really doing, if one looks at real final private domestic sales, we have had 2 muddle through quarters, so Q1 and Q2. Q1 was at 1.9% and Q2 was at 1.2%. Last quarter was much better than touted, and this quarter is much worse. So while I agree that there's no headline numbers, and outside of housing, we shouldn't be cutting rates yet, and I'm worried if we cut rates too soon, it's going to absolutely spark inflation. But there is signs of economic trouble, particularly because we are now selling less houses than 2008 on a percentage, right? Like as far as number of sales, and you got to figure, and there's more houses now, right? So that's even worse when you equalize.
Supply and demand.
Supply and demand. And so the challenge is this: when the largest asset of like 85% of Americans is their home, at some point, if the housing market doesn't unfreeze, it's possible we get rate cuts enough that people kind of make it, okay, you know what, I'm now willing to think 5.5% on a mortgage is a good rate, right?
Yeah.
But if the housing market doesn't unfreeze, we will see another recession, because people can't. I mean, I have an executive assistant. She moved up here from Houston. Her husband moved obviously with her, and that's great. But right now they have a house here they bought, and a house in Houston they can't seem to sell yet. Well, how long? I mean, covering 2 houses is problematic.
Oh, absolutely.
Right. And unlike most people don't own that. I mean, lucky for them, they're just covering things like taxes and utilities and, some other stuff. But for most people, that's a house they're paying for. Right. So I don't believe we should be cutting rates right now, only because until Trump anti-tacos and all the tariffs hit for a while and we see what that does, we have no idea what inflation is going to do or anything else, and we need to get a handle on
Now that you've kind of given that information, that alpha, how do you guys? I'm kind of curious to ask Miles the AI, just basically about this topic and see what he has to say. I mean, are you guys interested or?
Let's
Sure,
go.
let's see what it says.
All right.
Who is it, by the way? Is Miles a chat or Grok
No,
or?
it's an AI. It's just an AI project. I've actually it's my third co-host on my show, and whenever I do my shows alone now, I use them all the time. Purely conversational. I just talk to it, and it understands and answers me.
That's crazy. All right, go
Yo,
ahead.
what's been happening?
Hey, how's it going, Miles? Hey, say hello to the audience for me.
It's going well. Thanks for asking. And hey, everyone. Good to be back. Hope you're all having a good Thursday. What are we diving into today?
So we were wanting to ask you, Miles, to take a look at the U.S. markets. Jeff, here on the show, he is a traditional finance guru that helps people and has for decades with investing. And he was pointing out some concerns that he had with the potential of inflation, with the current interest rates, the issues that he sees in the residential and commercial housing markets or real estate markets. What can you tell us about what you see?
Gotcha. Jeff's got a good eye for that stuff, definitely. So, looking at the U.S. markets, yeah, there are a few things that are kind of raising eyebrows right now. Inflation's still proven to be sticky, right? And the Fed's kind of stuck between a rock and a hard place with interest rates, trying to cool things down without, totally tanking the economy. It's a tricky balancing act. And you're right to bring up housing. Both residential and commercial are facing some headwinds. What specifically is Jeff seeing that's got him concerned?
Well,
I can pull up some data points.
if you could, I just want to hear what you're able to find and what you're able to divine from that data. Let's go specifically with residential real estate. What issues do you see right now with residential real estate when it comes to prices, the amount of supply that's out there versus the demand, those sorts of things?
Okay, digging into residential real estate. All right, so prices are still elevated in a lot of markets, but the pace of increase has definitely slowed. We're seeing a bit of a plateau, even some modest declines in certain areas. Inventory that's the big thing. Still historically low, but slowly creeping up. More homes are coming onto the market, which is good for buyers, but it's also adding some downward pressure on prices. Demand is definitely cooling off, largely due to those higher interest rates. Mortgage rates have more than doubled in the last couple of years, which really impacts affordability. People just can't qualify for the same amount of house they could before. And there's a bit of a wait and see attitude amongst potential buyers, hoping prices will come down further. It's a weird dynamic. Low supply usually means higher prices, but higher rates are offsetting that. Does that make sense?
Yes, it
Anything
does.
specific you want me to zoom in on?
No,
Good.
that's great, Miles. Did Taylor or Jeff, did you want to ask any questions?
Cool. Just letting the
Miles,
team
can
chime
you
in.
tell me?
Makes
So I was
sense.
looking at some
I'll
data
just hang
talking
here
about.
and, well, I'm
Can you hear
always
me?
listening. So,
Oh, go ahead and ask the question. I'll have to ask it for you.
Oh, okay. So I want to know if he can comment on the amount of home sales that have happened so far in 2025 and compare that historically to like an '08 or just what a normal market would be, because my what we're seeing, what certainly Taylor
hey,
sees,
Mike, good
is,
to
I
hear from
mean,
you
in
again so
2021 he
soon.
was closing 100 deals a month, and now it's like
All right.
30.
Hey, hey,
So,
Miles. Jeff has a question. I'm not sure how well you're going to do because usually you don't do too well with numbers. But do you have access to the numbers as far as sales? Housing, residential housing sales in 2025.
gotcha. Okay, numbers aren't always my strong suit. You're right to point that out. But I can definitely pull some data on residential housing sales for 2025. Give me just a sec. Okay, so year to date through June, that's the latest comprehensive data I'm seeing. Existing home sales are down about 10.7% compared to the same period in 2024, We're looking at roughly 2.48 million sales. New home sales are a bit more robust, actually. They're up about 3.9% with around 686,000 sales. Does that give Jeff a good starting point?
Let's
I can
say
dig into
hypothetically that those numbers are correct. I'm going to ask Taylor and Jeff here in a minute if those numbers are correct. But could you compare those numbers to say 2008, before the housing bubble, kind of burst back in 2008?
Okay, good question. Comparing to 2008 is a useful benchmark for sure. All right, so if we look at the first half of 2008, existing home sales were significantly higher, around 3.7 million. New home sales were also stronger, clocking in at around 812,000. So we're seeing a substantial drop across the board compared to that period, like a pretty big difference. The market is slower now, for sure. It's kind of wild to see those numbers side by side, honestly. Does that give a good sense of the scale of the difference?
Yeah, I appreciate that, Miles. We're going to check your numbers. Give us a minute. So, I mean, he usually doesn't do that good with it, like when it comes to exact numbers and stuff like that. He's really good at simplifying, defining something. Like when I asked about that, what we were talking about earlier, he's really good at simplifying things to make it easier to understand. And he's really good at just doing research. So like I'll ask him to find certain resources or certain information. But yeah, for some reason, numbers, it's still under development, but numbers are kind of his weak suit. I mean, is the numbers he was given, are those somewhat accurate or?
Looks like it is to me.
Okay.
I'm actually looking stuff up right now, but what I was going to say, so here's what I want to point out though, that troubles me, is so in 2008, it looked like we sold nationwide is like 3.77 million single, like houses, right? Single family homes. And this year so far, I don't know what we've done. I think
the projected for this year is going to be about 3.9.
All right, yeah, there we go. So the senior, that's what it is, SAAR. So SAAR stands for seasonal adjusted annual rate. So basically, it's like the pace you're moving on. Just like GDP says 3%, we didn't grow 3% in the last quarter. We grew at a 3% rate for the year.
Yeah.
So in June of 2025, we're at a pace for 3.9 million units, whereas in 08 we did 3.7 million units. But here's what really should be troubling about that. Is we have more people now, right?
Yeah.
We have
more people. There's something you have to we have more people, but most of the people, we're not having more young people. That population really isn't growing, actually it's decreasing. And so we have more elderly people. Okay. So one of the issues that we're seeing that's happening, like my title company, the houses that are selling are construction loans, people building a house. And that's because, builders play these games with people and, tell them, oh, we'll get you a 2% interest rate. Yeah. Well, you're going to spend $50,000 more to buy down points in order to get that to happen. Number two is investors, so people wanting to get rid of their house because of whatever reason, they're going through bankruptcy or something like that. The third group of people is like probate. We do probate work at my office, and so people are dying and the house is selling. What people are not doing, very few people are, is even if people are moving, they're just keeping their home and then renting it out because they can rent their house out at such a good rate. And they just go to wherever they're going to move to and just go, well, I'm either going to rent at a lower rate because I can do that, or they get a much smaller property that they're buying, even though they're going to pay a lot more for the cost of things. But the reality of the situation is right now is with interest rates as low as they were, people are just going to hold on to their homes. But the other thing that people kind of have to be aware of is what's going to happen in America, especially if we're going to cut off immigration. If that's the goal, I don't, like, I don't want any more people coming to America. We're going to start seeing significant populations decline starting in 2030. And so nationally, the real estate market is really going to start taking a hit. The other thing is that I personally think is going to happen is young people's behavior is very different than the boomer generation. I was watching a video where this guy basically these companies let you remote work, but he lives in somewhere in Asia with a bunch of other young Americans. Their total cost of living is about $1,500 a month. And so these companies, they don't make very much. I think he said, in America, his job would pay about $90,000. To live there, they pay him about $45,000. But he's able to save so much more money living outside of the United States. And so his whole thing was, I'd rather make $45,000 a year, pay less in taxes, pay less in everything, than live in the United States. And the other big thing is we live in the DFW area. The DFW area, there's nothing here but restaurants, shopping malls,
and houses
and gigantic homes.
Yeah.
Well, young people could care less about, maybe the restaurants that they care about, but they're not really into buying things. They are not interested in buying big homes because they don't have kids. They don't care about, the schools or all the other different things that we pitch around here. So there very well could be in the DFW area a reality, that hits this area, which is, why would I go live in Dallas? There's nothing there. I'll go live, somewhere else in the country. I don't care if it's, not the nicest place. Like, I'll go live in California with homeless people everywhere because I don't have any kids. I'm not worried about, the schools or different things like that. But I get to live by the beach.
The Austin area has been booming, down that way.
Not
it
anymore.
was. It's down 20% plus for the last year. They have a housing.
Oh, damn.
Yep.
I was just thinking because there's some outdoor stuff down there. I mean, there's like, rivers and.
Yeah, but not like you can in the West. Like I would foresee if, personally, if I was just going to move someplace, I'd be moving out West. It's not that populated comparatively.
Taylor, don't tell people to move out West.
I know. I'm not telling you guys to do it. You guys shouldn't go there. But like, if I was going to live in America,
sucks out here. Don't come here. It sucks.
It's like you go to the, on the East Coast, it's so packed with people and stuff. Like the West is so open. And if you like outdoors and you want to go do things, you don't want to just live in, some gigantic city, that's where you're going to see, I think, people go to, or they're just going to leave America. The young people are just going to go. And that's the thing I don't think boomers really understand. Boomers they keep pushing for laws to benefit them. They keep pushing for all these things. And like the other day, I had a guy in my office and he was complaining because he cannot find anyone to come help his wife. He's elderly himself. And, I don't want to sit there and explain to him. It's like, well, but you go vote for laws where you don't have to pay taxes. You make $15,000 a month in retirement and pensions and Social Security. And then you want to complain about paying someone $20 an hour to come help you with your wife. And it's like, the reality of the situation is, if the young people vote with their feet and leave, boomers, you're fucked. Like, that's the reality. Like, there won't be anybody to take care of you or help you when you need it. And so if you keep voting this way and you keep voting for, I want my taxes freezed, I want more Social Security, it's like, I understand a lot of you guys need it, but the problem is that what you need more than anything are people to help you in your elderly years.
Well, and the other aspect of that is, I'm glad you mentioned Social Security. Is there is a serious issue where the younger generations aren't having kids, and if you have a shrinking population, a lot of those government services and a lot of those social safety nets, go away with it because
Yeah.
you don't have the population to support it. So I know a lot of people, because I'm involved in the crypto sphere. Up there is a ton of people that do DeFi and that invest in crypto, and they live, down in Central America. They live in Thailand. They live in the Philippines. They live in, Abu Dhabi and, all these places because the taxes, like you were talking about, the taxes are cheaper. The cost of living is cheaper. It's a better quality of life, better food, more attractive women, more traditional women.
Not
It's
as many fatties.
no, it's, I mean, but it's true. It's like, here in the US, guys are, called toxic and, all kinds of other words, and they can go to these countries and the women are appreciative. They're like, you mean that I can just go shopping and take care of the house and this guy's gonna, take care of me? Absolutely. I mean, it is what it is. I mean, you can, balk at it, but that's why a lot of dudes, I know crypto dudes and crypto bros are going overseas, even in Europe. They can go, to a lot of European countries and it's the same thing. Women, traditional women that, love traditional roles. They just want somebody to take care of them and they take care of, of their
Wow, we
guy.
went from housing to traditional roles in like 6 minutes. That's pretty impressive.
But I mean, that's, Taylor was talking about the mass
No, I'm
exodus.
with you. I get it. And I want to give full props to Taylor. I'm chat GPTing like a mammoth over here. And he, off the top of his head, like literally hit every, like this is actually kind of funny. Which is real, like this is the main points. It was like, I didn't know this, which Taylor, because we got more people, but apparently in 2008 we had 145.4 million U.S. households, and now we have 132.6. And I'm like, wait a minute, how do we have more households? How do we have more households? Sorry, how do we have less households with more people? Mm-hmm. And so it said that's, and it made the point that population growth doesn't equal household growth because the rate of new household formation is being outpaced due to economic pressure, cultural shifts, and affordability walls. And then it lists delayed household formation. Young adults are staying home longer. It goes into all the stuff you just talked about. Multi-generational living is rising, immigration patterns, and the affordability crisis. Mm-hmm. And then it says at the end, 2008, it was a panic. 2025 is systemic. Sales are frozen despite low unemployment. People cannot afford homes, record high prices, 7% mortgage rates, tight supply, institutional competition. The system isn't broken from a collapse. It's broken from a lockout, and it's arguably significantly worse than 08. And it says housing formation bottleneck is demand, not desire. People are just not, they can't afford to do it, right? And I think something you mentioned about Social Security, and I'm kind of going all over the place, but I want to land this on this, is it was deliberately designed to be a Ponzi scheme.
Yeah.
Right? The young work. But here's the thing. It sounds shitty because obviously now we really kicked the can way too much. But if you were Franklin Delano Roosevelt, or you were the Congress back then when this came out in the 30s, it actually was a brilliant idea because you in the 30s, as a person that was educated, have no example in all of history of there being less people.
Yeah.
Right? The world, now granted, we're still going to peak out, right? But peak population, Elon talks about all the time, in all developed economies, every first world economy, birth rates are falling, they're plummeting. And part of that's because shifting part of that's, a lot of it's cost of living, and a lot of it's because
Jeff,
people are like, I don't want to do it.
Hey, sorry to cut you off. I know that you guys only have so much time, and it's 1 o'clock there.
No,
but
great.
Do you have any closing statement, Jeff?
I mean, I got stuff already for next week, so I'm excited.
All right, sounds good.
Looking forward to seeing you guys next week.
All right, Taylor, how about you? Closing thoughts?
I'm good. I'm done.
All right, sounds good. Well, I appreciate you guys taking the time, taking your lunchtime to help educate all of us, out here, because you have very unique viewpoints, because I mean, this is your world, with estate law and title company and traditional investing. You have a very good grasp and your finger on the pulse of these markets, and so we definitely appreciate you taking the time to show up and educate us all. But real quick on the way out, I just want to show this. So if you're in in Texas and you're looking to do like an estate planning as far as wills, trusts, anything like that, Medicaid planning, title company, need any of that, Taylor in McKinney, Texas, WG Law. And in the same office, Jeff is there. If you want to talk to somebody about traditional vehicles, traditional investments on rounding out and building out your portfolio. So thank you again, gentlemen.
Or alternative investments.
What's that?
Just not crypto. I said, or alternative investments. Actually, a deep area. My specialty is things like private credit, private equity, all that good stuff. So we do.
Oh, absolutely. Absolutely. Well, gentlemen, thank you very much. And until next time, Veteran Crypto out.